Today, we are going to switch it up a little bit. I'm going to give you a little bit of insight as to what I'm doing when it comes to the market today. We know things are volatile. I've been sitting with cash on the sidelines, waiting for the right time to deploy. And I've come across a product that is very interesting to me. So we're going to be discussing what this product is, the pros, the cons behind it. And then I need your help to let me know down in the comments which one I should buy. I'm going to go ahead and buy that one, and we're going to track it over future videos. So if this is your first time here, welcome. My name's Nick, and this is Ways to Wealth. To start off, we'll talk a little bit about my mindset right now, and I am very hesitant to deploy cash. Now, when we look at the grand scheme of things, there's no better time to buy than now. That's why I've started heavily looking as to where I could put this money to work. We have inflation eating away at this capital. It's earning less and less for me sitting on the sidelines. So what can I do about it? And that brings me to what we are talking about today, and that is Purpose Investments. As a disclosure, I do not work for them. They are not sponsoring this video. I happen to enjoy this product. I think it could be very useful in times like this. And what they have just released only a month ago are ETFs that cover a particular company but give you exposure through yield. And the way that they do this is through covered calls. Now, we've touched on this topic before, and what I'll do is at the end of the video, I'll link to what that is so you can learn more about a covered call strategy. But all in all, what they're doing is they're using options to generate yield on these particular ETFs. Now let's take a look at the Purpose site, and we can see some of the names that are listed here. And we can see Amazon, Tesla, Alphabet, Berkshire, and Apple. These are all new funds within the past month or so that are yielding relatively high numbers. You have over 10%, 17%, and the list goes on. And we're going to talk a little bit right now about the pros as to why I am attracted to these particular ETFs right now. And the first one is that a covered call strategy is very good in a market that is volatile. It's not bullish, it's not bearish, but it's moving sideways. And the reason for this is that if the market's moving up and down, it's creating a lot of volatility. And from there, the premiums become higher. And what you're seeing in that is basically why those dividend yields or those yields essentially are so strong. And when we talk about that yield, the reason that is beneficial is that it's not treated like a traditional dividend, which is subject to a different tax. It's actually subject to capital gains tax, which is one of the most beneficial ways to be taxed in this scenario. So that is definitely an A+ for me, especially if I'm buying it outside of my registered accounts. Another way my brain is thinking about this is that if the stock market is volatile, I do happen to buy one of these names and it drops 10%, I could realistically hold it for a year and know that I'm going to break even. Now, I know that my mindset is actually looking 5, 10, 15, 20 years in the future. So I really look at it as I'm collecting 10 points on my investment, which is very good for me because I do like to clip a little bit of yield. I like a little bit of income from my investments, which you don't traditionally get from some of these names that are listed. Another pro to this ETF is when I look at the management fee, and it is relatively low at 0.4%. And this is in line with a lot of the other ETFs, which is kind of surprising seeing how it's an actively managed ETF. They're using option strategies, etc. So this is definitely in line with some of the other products I'm already invested in today. One of the things that I haven't mentioned as of yet is that these are Canadian traded funds, and they actually trade on the NEO exchange. So to our benefit, we can actually buy these American companies with Canadian dollars. So that is another benefit, that I don't have to worry about the exchange risk of buying these in US dollars. Now that we've covered all of the pros that I can think of, we now move on to the cons. And the first one that comes to mind is that if the market does happen to turn bullish and we are using a cover call strategy, this could be actually detrimental. This could fall behind holding the actual shares of Tesla or Amazon directly. So I want to make sure that if the market does turn bullish, I actually switch my shares out of this and head directly into the name. And this is kind of buying into the cover call strategy. So if it hits what my covered call option strike price is, then those shares are going to be called away. So basically, a bull market and covered call options don't really go hand in hand. So if we do go bullish, this could definitely be to the downside here. As these products are so new, I haven't really been able to go in and get a true indication of what the performance is, but I did look at the past month between the YTSL.NE, that is the purpose traded ETF there, in comparison with Tesla, and we can see here they actually work pretty much hand in hand together, and that is actually good news. Obviously, time will tell as the time goes on to see how these actually perform together, but you're getting the same similar type of performance along with the yield, obviously due to the option strategy. And that is something that is super interesting to me because it's a conservative way to get these growth names into my portfolio. I also aren't able to determine what the currency risk is in here. And maybe we could look back just to one of the platforms just to see what Purpose has to say about this. So we go into the Tesla one again, and we see that the maximum yield from holding Tesla shares is using covered calls and moderate leverage. Now, I don't know what they mean by the moderate leverage, but it's about 25% of the fund. And what we can see now in this current environment is that companies that are levered, especially the banks, they are going through tough times right now. So could this be a potential con or a potential risk to the investment? So the covered call option is about 50%, and the other is invested directly into the shares. And they are participating in the long-term growth of Tesla shares, which is good to know. We stay protected from currency, so it answered our previous question, and we benefit from tax-efficient yield, which we also covered before. So there is a multitude of different lists here. My preference is a company that's going to grow over the long run. So out of the names like Amazon, Tesla, Alphabet, and Apple, which one would you like me to see invested in, and which one would you like me to see track over the long run? And we can get an idea of how these will perform so that maybe it could be a potential investment idea for you. But it is important that you do your own homework. You take on the amount of risk that you want. Just because I'm investing in this doesn't mean that you have to. This is just a cool experiment. I like these products personally myself, and we can kind of follow along to see how they're doing. So let me know down below which ones you want me to invest in, and I will definitely do so and keep you up to date with what's going on. Additionally, if you want to learn more about the covered call strategy that I talked about, check out this video right here. Additionally, there is another way that you can buy these US companies in Canadian funds. I've covered this in a video before, so check that one out right here. I hope you all have a great week in the markets. Happy trading.